mode.
Good morning. Thank you all for joining today. Our webcast is Revenue Recognition Accounting for Cloud Computing, SaaS, and our guest presenter today will be Jeffrey Werner from the Werner Consulting Group. This is Caprice Murray from Tensoft, and I'll just be giving a few opening remarks and then turning it over to Bob Scarborough, the president of Tensoft. Just a few things about the webcast. If you have any questions, please do submit those in the Q&A panel over to your right. We will be issuing the CPE certificates to everyone who is eligible, and that is everyone who attends the entire session and who answers the polling questions. We'll send those out by Friday. We also will be recording this. And the slides and the recording will be available on Tensoft's Resource Center on our website by Friday as well. Any questions that you have afterwards or that you didn't get answered during the webcast, please go ahead and forward those to either Jeffrey Werner or myself. Email addresses are there. Do let us know if you have anything follow-up that you'd like to have an answer to, and we will respond by email, and we'll also be posting answers to questions on today's webcast and any follow-up questions on Tensoft's blog. So with that, I'm going to turn the session over to Bob Scarborough, Tensoft's president. Bob? Bob.
Morning, everyone, and thank you for your time. Can you hear me? I believe that I am online here, so.
You are, Bob.
Thank you, Jeffrey. So for those not familiar with Tensoft, we're a software company. We specialize in software products to help technology companies with their business needs. And we are located in Silicon Valley. We've delivered complete business software solutions to over 150 technology companies in North America, and really their subsidiaries and legal entities around the world. So specifically related to today, we have a deep focus on revenue management, and our software solutions in this area support revenue management, billing management when appropriate, business model or go-to-market model or omni-channel approach to how you do the transactions, all related to one revenue management system. And we do focus on making and collecting the data so that it's visible, and which drives analysis and understanding of your data, things that help you be productive by modeling your business processes and the way that you do work, and compliance specifically related to GAAP requirements. And we do support the revenue compliance models that Jeffrey's going to discuss today. So next slide, please. I think we have a couple different ways to do this, and really then that will wrap me up and to move on to Jeffrey. One of them is that in terms of bullets here, the way we think about philosophically, and I think it's a solid approach that makes sense to people when we go through it, is that we separate the revenue agreement, which is really capturing the sales transaction, applying a workflow to it, applying rules to it, applying fair value allocation as required to it. We separate that from how you go to market. And so if you think about it, really you have multiple channels and multiple ways to sell to your customer. You may have one in your company today or multiple in your company today, and you may have one or multiple tomorrow. However, once we capture the appropriate sales transaction, the multi-element arrangement or whatever the sales transaction is, and move it into the revenue engine, all the channels feed to the same place and allow you to recognize revenue consistently in a controlled, lower risk, processed manner. So next slide, please. Graphically, it appears like this, where on the left-hand side is your go-to-market model, where it could be a sale from your website or your contract, your customer relationship management system. It could be from our contract administration or any other contract administration system. It could be from your ERP system if you have a sales order-based model or other types of models. And all of those things we're capturing through several different technology gateways into the revenue engine. And what we're looking to is to capture the appropriate sales transaction, apply any document workflow required, do any fair value determination required, apply rules consistently, and then from beyond that, it's a compute post-report process where if we get the right agreement set up right in the first place, the revenue processes become simple, the reporting and analytics become robust, and really you have a controlled, risk-minimized process that supports however you go to market in a consistent fashion. So next, please. So, at this point, it's my pleasure to introduce Jeffrey Werner and to move on to the topic of today's session. And Jeffrey is an acknowledged expert in the area of software revenue recognition. He's been providing revenue recognition consulting services to software and technology companies since 2001. Prior to launching his consulting business, Jeffrey was the CFO of Antrim Design Systems, a mixed signal synthesis company based here in Silicon Valley. Before that, he was VP of Finance for Telepost, a web-based communication services company based in Santa Cruz, California. And earlier in his career, Jeffrey spent 11 years with KPMG Silicon Valley office, where he was a senior manager. Jeffrey regularly teaches software revenue recognition classes in the San Francisco Bay Area, has over 15 years of experience helping companies comply with revenue recognition regulations and policies and best practices. So, Jeffrey, the floor is yours. Thank you.
Well, thank you very much, Bob. And let's take a look at a couple things. Before we go through our agenda for today, I want to mention that we do have another one of our 2 half-day webcast classes coming up. The title of the class is Revenue Recognition for Technology Companies. That'll be November 12th and November 14th for 3.5 hours each morning. There is CPE credit, and it's a pay per attendance. And there'll be a registration email going out soon to offer that class to you.
Welcome to GoToWebinar, Web Events Made Easy.
Objective evidence, or VSOE, software revenue recognition, and services and contract accounting. That's the first half day. The second half day reviews some of what we did on the Tuesday session, finishes services contract accounting if we haven't done that, talks about the relative selling price method, and then cloud computing or SaaS, which is today's session is a subset of that module. And then we spend time with the FASB-IASB revenue recognition project, a new revenue standard that is coming out. That is nearly final and is getting a lot of discussion. And then a number of other revenue recognition topics. So with that, we're going to begin our session today on revenue recognition and cloud computing. And I think we'll take our first polling question if we can get that up and ready. Here's our outline for today. We'll talk about the cloud or SaaS business model. When is it software? When is it a service? Look at setup fees and related costs, some of the consulting and the training services that might be offered as part of a cloud computing or SaaS business offering, fees based on usage. And then when we've got multiple element arrangements, whether they're with a variety of things or also with software sales, how we do the accounting for those. We've got a number of examples. So that's our agenda for today. And our first polling question, I'm not seeing that. Is Webcast to gain more insight about the topic for my SaaS company, to gain more insight into the topic for my clients, or to get CPE credits. So the polls are open on that, and we'll move forward with our slides and get going on the content. The purpose of the polling questions is twofold. It's both to allow you to get CPE credits and also to let us know a little bit more about the people that are attending the webcast today. Just a little background on SaaS as a service or the cloud computing model. Years ago, we had something that people referred to as the application services provider. In the nomenclature became software as a service, and now you might hear it more commonly referred to as cloud or cloud computing. It's a hot new business model. Lots of software companies are moving to this type of a business model or go to market. And one of the attractions of it is it provides this recurring revenue model, which is generally valued favorably by the market. And it's use of software rather than owned software. The types of services or offerings that you might have from a cloud company or a SaaS model would be applications, which you're familiar with, that you use on a daily basis, but also platforms and infrastructure that support the application providers, and then other services. So some of the platform and infrastructure companies might be like Google or Amazon, which offer server farms that are available for cloud computing companies, and also companies that offer various services and software to manage the provision of cloud services. Cloud computing's evolved over the years. As the internet became more robust, companies wanted to have the benefit of the service of the software rather than owning it. And 10, 15 years ago, Salesforce.com really made this an acceptable business model with their success. From a customer's perspective, its SaaS or cloud-based business model is easy to implement. It's ready to go. There's a standard setup, typically a low upfront cost compared to purchase, implementation, and owning of software. You pay as you go, and you don't have to take care of it. The vendor keeps it running for you. So smaller companies can be much more adept and virtual without an internal IT group. In general, you can save on licenses. You buy what you use. You don't have a lot of administrative costs. Updates are easy to do and are done for you rather than having to go out and update each computer that has a program on it. And it's easy access over the internet through a browser. Employees can work anywhere, anytime, around the world, around the clock. And it's network rather than PC-based. Some of the advantages for the vendor is it can be an easier sale because there's a lower upfront cost of ownership. It's a predictable, ratable revenue stream, which makes forecasting and provides some valuation benefits to the company. It's easy to upgrade and change features. You don't need to carry multiple versions of your software and continue to update all of those. You can have one or two that are available on your servers for your customers, and customers can get locked into the usage and continue to be ongoing customers. From a customer perspective, there are some disadvantages, particularly in the early days. Here you've got a mission-critical resource that's in control of the vendor, out of your control, outside your company's walls. The data's at the vendor. Maybe there's some privacy concerns concerning that. And then uptime's dependent upon your internet connection and your vendor's service record. So those are all some of the disadvantages, proving to be less so over time. Vendor disadvantages, you don't get these one-time large pops of sales, but then you don't have to keep hunting large sales if you build a consistent base of recurring revenue. And you have to have a customer focus, because if you don't keep up your service, you'll lose your customers. So that's some of the background on how we got to the cloud computing or SaaS, software as a service model. And when we want to do the accounting for that, the critical question that we have to ask is it software or is it service? Because we're going to recognize the revenue in very different ways depending on how we answer that question. So that's the first thing we need to take a look at. It's software if the customer takes possession of the license and either hosts it on their own computers or on a third party or on the vendor's servers. If they host it on the vendor and they have the right to take possession of it from the vendor without significant cost, those would all be indicators that it is a software sale or a software license rather than a service. If you've purchased a software license, you have the right and ability to use it without your vendor. The only real connection you would have with them would be software support and maintenance over time. You'd typically see a perpetual or a term license for the right of the use, and your invoices would have things like license fees and support fees. Upgrades might be part of support and maintenance or separate upgrade fees. The data is going to be at the customer. And I find that particularly in the early stages of SaaS computing and contracts, sometimes the contract may not be clear. But these are the questions or salient points that we would look at to make the determination that the offering was software. We contrast that with what would be the indicators of it being a service. Well, typically it would be hosted by the vendor, and you'd see monthly or annual fees or usage fees as opposed to a perpetual or a term license fee. The data is going to be on the vendor's server, and you might have data transition or conversion rights if you cease to use the service. It's a right to use only. You don't own the software, but you get the functionality and the solution that's provided by the software. And even if there was a license contractually, if there's significant additional cost for the customer to take possession of the software and use it, then even though the contractual terms may state that it is a license sale, it may be accounted for as a service because it would be impractical and costly for the customer to do that. And again, these things might not be clear, crystal clear in the contracts, but you'd go through these points and you'd make a determination of whether the contract is a sale of software, a license of software, or a service. And depending on your answer, then we're going to see how we do the accounting for those two. Now, regardless of whether it's a software license or a service that we're offering, we still need to follow the 4 general principles of revenue recognition that come out of 97.2 or SAB 104. We need to have persuasive evidence of an arrangement. Delivery or performance needs to have occurred. The fee needs to be fixed and determinable, and collectability needs to be probable. So we still need to meet all 4 of those criteria. And if you have you want an easy mnemonic, it's not ABC, it's C, D, E, F is your little memory device, where C is collectability, D is delivery, E is evidence, and F is the fee is fixed and determinable. So if we've met all those 4 criteria, then we're going to go to our revenue recognition steps. What we'll do is we will first separate out our transaction into the elements if we have more than one element. Then we would allocate the revenue to the elements, and then finally recognize revenue for each one of the elements as we complete our performance for the customer. When we go to determine what are the elements of the obligation or an arrangement, here's some guides for us. Well, if it's something that's named in the contract, it's probably an element that we need to consider whether it has separate value and needs revenue allocated to it individually. If it requires a distinct action of the vendor, and the transaction price would vary if it's included or not included, or if there'd be some kind of penalty or price reduction if a particular obligation or element wasn't delivered or performed. When we look at the separation of the elements, we look to see, are these elements independent of one another? Are they independent functionally? So if you only purchased one of the elements, could you get the benefit of that purchase? Are they independent contractually such that payments aren't linked or contingent? If you buy the service A or the license A and you also buy B, if B isn't delivered, do you get to return A or not make any payments? Are there any rights of refund or return that are associated with any one of those elements that might cause us to evaluate whether the element is an individual element, a separate element that we need to account for, or part of a group of elements that we'd account for together. Individual elements have standalone value if they're sold separately by the vendor or any other vendor, or if they have resale value. We don't run into that too much in software services, but those are some of the criteria that come out of EITF 08-1 or now the codification 605-25. If they can't be separated, or if don't meet these criteria for being treated as an independent element, then you're going to treat them as one unit of accounting. But if you do have multiple elements that meet these requirements, then you would need to do the allocation between the elements. And here's where the differences appear between when we answer that question, is it software or is it a service? Because software revenue recognition has a different methodology. It uses the residual method that was originally established by 972 and is now governed by the codification 985-605. Service revenue recognition uses VITF 08-1 or 605-25, uses the relative selling price method. And we'll look briefly about the differences between these two and then go into how we do our cloud or SaaS computing. So for the residual method for software, we need to have VSOE for any undelivered elements, and we defer the full value for them. And then whatever's left, the remaining value after we've deferred the undelivered elements based on VSOE, we recognize for the delivered elements. So if we had a software license and support, we would defer the amount of the support, and then whatever left is over would be the license revenue that we would recognize typically on delivery of the license. That's the old software revenue recognition model. Now for services which are marketed under the SaaS or the cloud computing model, we're going to use a different methodology. We're going to use the relative selling price method, and we're going to allocate to each element based on that element's percentage of the total value in the transaction. We have a hierarchical valuation methodology, which is based on whether we have VSOE, which is vendor-specific objective evidence, third-party evidence, which would be what another vendor would sell it for, or ESP, our estimated or our best estimate of selling price for an element. And we would defer the revenue for any undelivered elements and then recognize the revenue as we deliver the elements. I think it might be time for our second polling question, so let's take that now. And also take a look and see if we've got any questions that have come in. So our question is, what percentage of your company's offerings today are SaaS? And you can see the percentages there. And here's our question. Let me just read it before I speak out loud. Okay, so the question is, when a hosted services offering, or SaaS, is sold in conjunction with a software transaction, I'm assuming that's with a software license, like a perpetual license, that includes post-contract support, what are the VSOE implications? How is the revenue recognized for each element in the arrangement? Well, thank you for your question. We do have a couple slides on this later, but the straightforward answer is, if you've got a multiple element arrangement that includes both a SaaS service arrangement and software license, you're going to follow this relative selling price method to allocate the revenue to the various elements. Then you're going to separate out the software elements in one group and the non-software elements or the service elements in another group and recognize them separately. Those software elements will require VSOE for any of the undelivered elements, in this case the PCS. And I think I'll leave it at that because I've got an example later in the slide set that goes through this situation with some numbers, which I think will help you to understand that better. So thank you for that question. If anyone else has a question, you're welcome to type it in there in the question and answer session. And have we moved on from our polling question? So we'll move to the next slide. The types of multiple elements that we might have in a SaaS or cloud computing multiple element arrangement would be things like the subscription fees, the monthly or annual fees that we charge the vendor charges the customer, any setup or implementation fees, maybe their data migration or content creation type fees, any consulting that we might do, any business process consulting, there might be training, project management, usage fees. There's lots of different services and fees or charges, items that are sold to the customer by the vendor. And if we have any or all of these, then we need to do that multiple element arrangement separation, allocation, and recognition process that we talked about earlier. We need to ask ourselves this question, though. Do we have standalone value? Because often in SaaS arrangements, while there might be multiple things that are on the invoice or the contract, they may not have standalone value if they don't have value to the customer separate from the service. But we do need to remember that standalone value includes items that are sold separately by another vendor. So if you could get that same item from another vendor, maybe training for a well-known SaaS offering that there are independent vendors that provide that training, or other types of consulting and services. If you could buy those separately, then they may very well qualify to be individual elements that would require allocation when we do the revenue recognition. Upfront type setup fees or implementation fees typically are not going to meet that criteria for being independent, because if you weren't subscribing to the service, they would have no value to the customer. And typically, the customer can't buy those setup services from another vendor, because the SaaS or cloud computing vendor doesn't typically allow third parties behind their firewall to set things up. So if that's the case, then if you had a upfront or setup fee and a monthly or annual subscription, you'd have to account for those as one element, not as two, because they don't meet the criteria that we talked about earlier to be considered independent elements that we would allocate value to and recognize separately as part of a multiple element arrangement. We did have another question come up. Is there any way to avoid multiple element arrangement status for a subscription plus a setup model? Could I embed the setup fee in the subscription? Yes, you could. You could make that all one charge, and if that setup fee wasn't available separately from your company, the vendor, or from some other vendor, then that could all just be part of the services. Maybe you'd structure that on the contract of the invoice that would say, SaaS services, $10,000 for 1 year includes, and then have the smorgasbord of items that it includes. Of course, it's all going to depend on the actual wording of the contract and the facts and circumstances, but there are ways. A lot of companies like to break these out separately because they find that they can manage the fee negotiation a little bit if there's multiple elements rather than one. But again, it's all going to depend on the facts and circumstances. Thanks for your question. There is another issue with setup fees, and that is, how are you going to recognize them? Are you going to recognize them over the contract period or some other period? SAB 104 had this concept in it that said if you had set something up for a customer, it is similar to creating an asset for the customer, and you would take the revenue for that asset over the asset's life, which might be a longer period than the initial contract period. And this seems to be evolving to be the dominant position in the SaaS and cloud computing community, and it is a position that the SEC has tended to take for public companies. The alternative perspective is that if it doesn't have standalone value, it's one unit of accounting, and that one unit of accounting is taken over the contract period. So I do see it done both ways, but I see many more companies going to the first methodology, where they analyze those setup fees as to whether they have a life that's longer than the subscription period. So if they're entering into 1 year subscription contracts and they feel like the setup fees generally have value to customers, say 3 years, because their typical customer life is 3 to 5 years, then they may take those the setup fee revenue ratably over that longer period. So it's something that you need to carefully analyze. It may be that if you have longer contractual periods that you may not see any difference, or if you've got a really high churn where you're doing 2-year contracts and you have a high number of customers leave and join each year, then maybe the contract period would be the customer life. It's all going to depend on your facts and circumstances, just one of the complications. If you do have costs that are incremental and direct, related to these upfront services. There is an accounting election. You can either expense them as incurred, or you can defer and charge them to expense in the same manner you're recognizing the revenue. So if you're deferring the revenue and recognizing it over 2 years, you could defer and take two costs, the incremental and direct costs over that 2-year period. You need to be careful here, though, because incremental and direct costs are specific accounting language that require those costs to only have been incurred for this contract. So if you've got a team of people who do your setup, but they're on salary and they work for you and they do other things when they're not doing setups, that wouldn't really meet the incremental requirement here. But if you outsource it to a third party and they only do and charge you by the setup or the installation, then that would clearly be incremental and direct. And this is an option that the vendor can take. It's an option that should be applied consistently. So if you elect to expenses incur, which a lot of companies do for the ease of the accounting, then you need to do that on all your transactions. If you elect to defer and charge to expense over the same period that the revenue is recognized, then you need to do that for all of your contracts. If there are monthly or usage type fees, you're typically going to recognize those as the usage occurs. So this is similar to your cell phone bills or your PG&E. If you've got variable usage and you get charged based on that variable usage, either a set number of minutes or volume of electricity or gas, then you're going to recognize those typically in the period that the usage occurs, or bill them in arrears and recognize in the immediately following period. Let's go to some examples now, and I've got 3 examples that show a very similar offering where we price it in different ways, and you can see how the accounting changes based on the way that the pricing is done. So in this instance, we've got a SaaS or cloud computing service that the vendor is offering to the customer. It's a $1,000 a month fee, and it's a 1-year contract. It's renewable in the 2nd year for the same amount, for $12,000. So we're selling that service for $12,000. In addition, we're selling consulting services to the customer. We're selling 5 days that we price at $2,000 a day, which is our VSOE for that service for $10,000. So there's a total of $22,000 that we need to account for. And we go through our criteria that we talked about earlier. We're going to separate those out into individual elements. In this case, we have to ask ourselves, does the consulting have a separate value from the monthly service? If it does, then we could treat it as a separate element. And in our next slide here, we look at, well, what is the valuation of each one of our elements? Well, it's $12,000 or $1,000 a month is our monthly service fee, and based on the fact that we sell it for that same amount in the 2nd year, we're going to consider ourselves to have a value for that, and we've got VSOE for our consulting. So there's really no issue in the allocation because both are fully valued, and we would recognize them $1,000 a month for the service fee and the $10,000 for the consulting when it's provided at $2,000 a day. If the consulting didn't have standalone value and it wasn't a setup fee, but it was another type of consulting, we would just have one element of the arrangement, and we would recognize that $1,800 a month. So that's our first example. We're going to change the facts a little bit slightly in our second example. And here we've got the same offering, the 1-year contract that's typically a $1,000 a month fee, but we're going to discount year 1 down from $12,000 to $10,000. We've kept our consulting at $2,000 a day, and now we need to account for these based on their relative value. We know what those relative values are. It's $12,000 for the subscription and $10,000 for the consulting. When we look at those, we've got a $22,000 value that we're selling for $20,000, so there's inherent discount in there of about 10%. And when we do the relative selling price method, we multiply our fee, the $20,000, by the percentage of each element. So the subscription is going to get $11,000 allocated to it, and the consulting will get $9,000 allocated to it. But we've got another consideration, which is we can never recognize more revenue than we're going to get for a particular element, so that subscription, which we're only going to get $10,000 for, we may be limited to only recognizing $10,000 until we've completed all of the consulting and have earned that $10,000 fee from the customer. Similarly, in example 3, if we had the discount reversed, if we sold the service at the full value of $12,000, but we discounted our consulting down from $10,000 to $8,000, we would go through that same process where we do the relative selling price calculation. We look at our values. In this case, the subscription value based on ESP or VSOE is $12,000, and the consulting is $10,000. So we learn that doing the math, the subscription is 55% and the consulting is 45%. We multiply those two percentages times the $20,000 that we're going to get for the arrangement, and we come up with the values that we'll recognize for each one of those. And again, revenue may be limited for the amounts that are contingent based on, in this case, the performance of the subscription. So that's the application of the relative selling price method. If you haven't been familiar with that, if you've been working in the pure software world, it's different because you don't defer the entire amount of revenue for the undelivered elements, but each element gets a percentage based on their value. And we do have this second step where sometimes our revenue is limited for a variety of reasons depending on the values that we've ascribed to the undelivered elements. Let's go to our third polling question now and also see if any other questions have come in so far on this morning's webcast. So our polling question is, when did you first start offering SaaS solutions? In the last 12 months, last 2 years, last 5 years, maybe there's 5 or more below that. I don't know, or do you just have 3 bullets? And so then the question that we had is, what's the key difference in a SaaS offering versus a software subscription, and how would the accounting treatment differ? Okay, so I think one thing we need to be careful about here is use of the word subscription, because a lot of folks use that in different ways. If you're selling a software license to a customer, and that license includes the rights to any new functionality in that software family over a period of time, this is separate from when and if available updates and maintenance. It's typically characterized as PCS or software support and maintenance. That is typically characterized as a subscription, and you recognize that ratably. In here, though, we're talking about a software license that's sold to the customer. They take possession of it, they hosted it on their own servers or get a third party to do it, and it is a software license. So that sale is going to be accounted for under 97.2, S&P 97.2, software revenue recognition accounting, or 985-605 in the FASB codification. And you would follow the residual method. Now, typically for a subscription type offering like that, the revenue would just be ratable because you don't have VSOE for those potential offerings that the customer gets over time by being a subscriber. So in the software model, it would be ratable revenue recognition. In a SaaS model, you'd have to look at whether those items had separate value and do the allocation in recognition under the relative selling price method. if you had multiple elements. There may not be a difference in the revenue recognition between these two situations, but there could be, depending on the facts and circumstances and what other elements might be sold with them. For example, a subscription license and some other perpetual licenses. So, but people do use that term subscription interchangeably with a true subscription, where, like a magazine that you subscribe to, you get whatever comes out and whatever's available over a time period. And sometimes people use subscription accounting to describe ratable revenue recognition, which isn't always the same thing. For example, you would use ratable revenue recognition in a software sale if you didn't have VSOE for the support and maintenance, or the PCS. You'd be taking the license and the support and maintenance ratably over the support and maintenance period, rather than on delivery for the license. Looks like we had another question. In example 3, the subscription revenue is then $11,000 for the 12 months? Yes. And when is the consulting revenue recognized? As the hours are incurred? Yes. So it would depend. If it was on a daily basis, you'd recognize 1 day for each day that you worked. If it was some sort of completion that you needed to turn the switch on, there may be situations like that where you would do it either on a percentage of completion or a completed contract basis. It would really depend on the facts and circumstances. Here we're trying to do a more simple, straightforward sale, example rather, to illustrate how you do the allocation in percentages, the calculation of the revenue, and also to focus on that limitation that you might have depending on which element gets allocated more or less than its contractual amount. Let's move on. If we have multiple element arrangements that include SaaS products and software, and this is the question that we had earlier from one of the attendees, we're going to follow our same methodology. We're going to separate out that transaction into its various elements. We're going to use the relative selling price method to allocate the revenue to each one of those elements. And then we would recognize the revenue for each element, the product, the service, the software, the SaaS service, etc., as each element was delivered. This is our example. So we have a software company. It's entering into an arrangement with a customer, and you're going to deliver a software license, so perpetual software license, which is A. Support on that software license. In addition, there's 2 other elements. It's going to be a 1-year SaaS service contract, which is service B, and then some other services, services C, if you will. And the contractual pricing in the evidence of the arrangement is that the license is $100,000. The support on the license is $20,000, probably based on our 20% of the net license fee PCS supporting methodology. The SaaS service is $50,000, and the other services are $30,000. So we have a total here of $200,000 of our total contract price. We look at the various elements and we say, well, the license is a separate element, the support is a separate element, the SaaS service is separate. We offer all these things separately. So we've got 4 elements that we need to allocate the revenue to. And we come up with our values for them. Typically, companies don't have software companies don't have to have ESP for a license if they're a pure software company and only sell software support, maintenance, and services. But in this case, we're required to come up with an ESP for the software license. In this case, arbitrarily, we've assumed it's $130,000. Our support is based on our VSOE, which in our example in our model is $20,000 because it was 20% of the net software license fee. Our SaaS services based on VSOE or ESP of $60,000, and similarly our services value is $40,000, just givens in this example. And so we have a $250,000 total value in this transaction that we need to allocate to the various elements. When we look at what percentage each element's value is of the total value, we come up with the license is 52%, the support is 8%, the SaaS service is 24%, and the services are 16%. So we will take those percentages and apply them to the contractual amount to come up with what the value of each one of the elements is going to be for revenue recognition, allocation, and recognition. So in this case, 52% of the $200,000 gets us $104,000 for the license, $16,000 for the support, $48,000 for the SaaS service, and $32,000 for the service. Just doing the math with those percentages. And you know that notice that these allocations are different than the contractual amounts. Then, since we've got a multiple element arrangement that has software elements, because the software license is a perpetual software license, and so it's governed by 985-605 or SOP 97-2, we're going to have to break out our elements now into two groups, those that are software elements and those that are not software elements, for lack of a better term, and recognize them based on their methodology. So for the software elements, we've got $120,000. That's the 104. Let's see. Where was it? The $104,000 for the license that we allocated and the $16,000 that we allocated to the support. We've got $120,000 total of software elements. Since we're following software revenue recognition for those, we have to defer based on VSOE for the support. So even though we allocated $16,000 to it, we're going to defer $20,000 and recognize that ratably over the 1-year support period. And the license, which we had allocated $104 to, will get $100 recognized on delivery for the license. $120,000 is the total for the software elements that we're going to recognize. For those non-software elements, the SaaS, we would recognize the $48,000 ratably over the 1-year period, and the services, the $32,000, whether they were provided on a daily basis in this example or if they were on a fixed fee basis, either a percentage of completion or completed contract method, depending on the facts and circumstances of the situation. So you can see that when you've got a multiple element arrangement that includes both software licenses, perpetual or term licenses, and software services, you've got a multi-step arrangement that you've got to go through. You've got to go through your separation out into the elements, gather the value of each element and do the allocation to each element. And then when you do your recognition, you need to group all the software elements together and make sure you're still following software revenue recognition for them, and follow 605-25 multiple element arrangement for the non-software elements. So it can get to be a very, very complicated situation. And I might say, in this situation, if you had the $120,000 total revenue allocated for the software elements, if we didn't have VSOE for the support, we would be required to recognize that $120,000 ratably over the 1-year support period because we'd be following software revenue recognition guidance. So I think it's time for our last polling question. And also an opportunity, if you've got any other questions that have come up, we could take a look at those now. So how do you currently manage your revenue recognition accounting? Do you use spreadsheets, an on-premises ERP accounting system, a cloud ERP accounting system, a best-of-breed third-party revenue recognition solution, or you don't manage your revenue recognition accounting, I guess. That's in a. So let's see what we've got as far as questions. This one is, what is the preferred method to determine the relative selling price? a gross margin approach or a discount off of list? Well, the preferred methodology is to follow the hierarchy of the revenue recognition, which is if you have VSOE, you use that. If you don't have VSOE, you use third-party evidence if you have that. If you don't have third-party evidence or VSOE, then you use your management's best estimate of what the selling price would be, and there would be a number of methods that you could use. Cost plus a gross margin might be the best, if you, particularly with tangible items, where you have costs or standard costs and group margins or product margins that you can use. Or you can do some sort of VSOE light type approach where you look at what the normal selling price for an item is, might work as well. If you have a list price, that's going to depend on, I think, whether you've got a group or product family average discounts that you would take off of that list price, unless you always sell your items for a list price. What's our next question there? Do you recognize license A on delivery? So in that example of the software license with the SaaS service, typically if you had VSOE for the support, you would be able to recognize the license on delivery. In this case, though, you're going to recognize $100,000 based on the residual method of the software elements, not the $104,000 that was allocated under the relative selling price method. What's the point of doing the RSP analysis if we're not allocating our revenue based on the RSP? Well, we do that in the case where we've got software elements that are in the same transaction as non-software elements. That's where we do it. And also we do it if there's some sort of constraint or limitation on the revenue recognition for a delivered item if some of the allocated revenue is contingent upon delivery of another item. So that's why we do it. It's the relative selling price method has that problem that if you discounted the first item that you delivered, and when you did the relative selling price allocation, some of the contractual value of the undelivered element got allocated to the delivered element. If you never delivered the undelivered element, you would end up recognizing more revenue on the delivered element than you could ultimately collect from the customer. This never happens in the software world, because when you always defer based on VSOE, you've always got all the revenue deferred for the undelivered elements, and if you end up not delivering them, you haven't recognized too much revenue for the delivered item. So that's where that comes up. Another question is, with regard to the matching principle, how are the related COGS expensed for SaaS when the revenue is spread across the length of the contract? Well, we talked about that earlier. You do have, for incremental and direct costs, you do have the option to defer those costs and recognize them over the revenue period, but they're going to have to be incremental and direct, and there's going to be some analysis required for that. Typically in our revenue recognition methodologies, it's been perceived that getting the revenue correct was more important than meeting the matching principle. So sometimes we do find ourselves in revenue recognition having the revenue and the expenses for an item recognized in different accounting periods, and the matching principle not followed 100% because we have taken the position that getting the revenue correct is more important than the matching principle. And so this will affect gross margin. How is this perceived in the industry? Well, it depends on the results. Sometimes it's perceived as difficult to explain. I think is one of the more troublesome aspects of that. But also, it's just going to depend on your revenue recognition methodology. If you are deferring those costs and recognizing them in the same period as the revenue, then you're not going to have that issue. So it's just one of the quirks of RevRec. I think that's the questions that we've got, and we're coming up towards the end of the webcast. So if you do have any other questions, you're welcome to put those through. I just wanted to remind you what we talked about here. To go back, The big question, if you've got a cloud computing or a SaaS software as a service, a business model, you need to look at whether what you're selling is software or whether it's a service, because you're going to recognize the revenue very differently depending on what your answer to that question is. If you've got multiple element arrangements, you're going to need to do the separation, the allocation, and the recognition. Setup fees and other related costs. We talked about how we do the accounting for that. Setup fees may be recognized over the contract period or a longer period. The related costs could be expensed as incurred or deferred and recognized in the same period proportionally as the revenue. When we have consulting and training services, you need to determine whether those are standalone value items or items that need to be recognized as one unit of accounting. Typically, we're going to recognize our fees based on usage, if they're usage-based fees. And then finally, our example of when we have a more complex and complicated transaction, when we have both SaaS and software licenses sold in a multiple element arrangement, the multiple steps that we need to go through in order to do the revenue recognition and accounting for those elements. So that's really going to kind of wrap our session up today. Again, I want to remind you we've got the software or the revenue recognition for technology companies webcast is coming up in a month in November. It's November 12th, the first half day, and November 14th for the second half day. It's a full 7 CP hours of credit. It is pay per attendance webcast, and we'll be sending out the registration and detailed information soon. The agenda for that webcast is a section on general principles of revenue recognition, how we address multiple element arrangements, vendor-specific objective evidence, how do we obtain it, how do we establish it, how do we maintain it, the rules of software revenue recognition, services and contract accounting. That's our first half day of the agenda. Second half day is a review of the general principles, finishing any of the service or contract accounting we didn't get to, the relative selling price method of 08-1 or 605-25, cloud computing and SaaS type arrangements, a module very similar to the items that we've discussed here today. We're going to spend quite a bit of time on the FASB IASB revenue recognition project, the new revenue recognition standard that's coming out and will be effective in 2017, but may require companies to have a retrospective adoption, which would mean your revenue recognition in 2015 and 2016 would have to be presented on the same methodology as in 2017. So that's a huge topic that's getting a lot of attention these days, and we'll spend some time on that. The new standard isn't final. It's expected to be final either in November or December, or if they slip into early January or February of next year. But this is the future of revenue recognition, and is going to change a lot of things that we talked about today and a lot of things that revenue recognition accountants have done for years. And then finally, at the end of the second day of the two-part webcast for revenue recognition for technology companies, there'll be a section on other revenue recognition issues, things like gross versus net, payments to customers, a whole host of other topics. So hope you find that interesting and register to attend. Hope you enjoyed our session today. I think talking about the FASB ISB project, the next one of these complimentary 1-hour webcast will be a abbreviated or digest version of the module from this two-half-day webcast on the FASB ISB project, and we'll probably wait until that's final. So if it's final in November, we might be able to catch that up in December. Otherwise, in January or February, we'll announce and present another one of these 1-hour webcasts. So our time is up. Thank you so much for joining us today. Again, if you've got any questions, you can reach me directly by email from this, the email on the slide, or through Tensoft. The slides will be available. The CPE credit should be going out by the end of the week, and we will have a recording for encore broadcast of this webcast that should be up on Friday as also. Thank you very much for joining us today, and have a pleasant good afternoon and good revenue recognition.